Welcome back to the channel, friends. Hope you're doing well. Now, on my channel, I speak about three things mostly: Bitcoin, real estate, and ETFs, especially American ETFs. Personally, I invest in the S&P 500 and the NASDAQ 100, some of the most popular and biggest companies in the US. Though I'm personally actually originating from Europe. I'm a German myself, but live across the world in different countries over the years. But still, my roots are European. Even though I'm currently living in the UAE and Dubai, I still want to have a look in this video into European ETFs. As you know, I'm a big fan of ETF investing versus individual stock investing. Finding companies that you want to invest in for the next 5, 10, 20 years is rather difficult, but finding an ETF that follows a number of companies based on specific target and requirements and other things, that makes it much easier. It's much more passively investing for the long term. Works for me, and honestly, long term, it's actually very hard to outperform some good ETFs. But as I said, I mostly focused on the US ETFs. So in this video, I really want to dive into some of the top performing European ETFs, see how they compare to the S&P 500, for example, the golden benchmark of stock performance, I would call it, and see what are some of the companies included in it. Because I know a lot of you watching are actually from Europe, and some of you may want to invest into the European market, which is totally understandable, right? Well, you still might have some global exposure or US exposure, which I'm always a fan of. At the same time, there is sometimes a little thing called home bias, right? You want to invest into companies maybe from your home country or at least from your continent. And why I thought about this, because recently I spoke during one of our live calls inside the Smart Money Club, which, by the way, if you haven't joined it yet, check out the link down in the description below. Amazing community to connect with like-minded people. We have weekly calls over there, community discussions. You can send me DMs, ask me anything. I think you might enjoy it. And he told me that he mostly invests, like myself, into the US, but he's also from the Netherlands, and therefore he just has to spend some of his money on one of the most popular stocks from the Netherlands, ASML, a great company, just because he wants to support the local economy. And honestly, I totally get it, right? Well, it should actually be mostly about performance, but you still have also some great performing companies in Europe. And why not support also some local or at least European companies? So without further ado, let's jump right in. I can really only recommend justetf.com. Great resource, free of charge, and yeah, I've really been loving it for all the ETF research that I personally do for myself. Now here we look for the best European ETFs. Now obviously there are way more European indices out there. Every country technically has their own index, right? Like the CAC 40, the 40 biggest countries in France, or the DAX 40, the biggest 40 companies in Germany. So there's different national indices, but here again, we want to track European. So within Europe, not just per one country. So here they listed 4 of the biggest one. The first one being FTSE Developed Europe. Then we have the MSCI Europe. Then there's the STOXX Europe 600, arguably the 600 biggest companies in Europe. And the last one, Selective GBS Developed Markets Europe Large and Mid Cap. That's a complicated title. Personally, haven't heard about that one before, and that tracks 2 ETFs. So you see here the number of ETFs, of course, investment focus. All of them are focused on Europe. That's how it should be. Number of constituents. That's the number of holdings within each ETF. And then a short description of what it is. And we can also flick quickly to the performance to see overall which of those actually did the best so far. Well, and in fact, honestly, they more or less do all a very similar job. As you can see, over a 5-year period, I mean, literally, there's less than 1% between all of them, which is quite surprising, I must say. So regardless of how they split it and how they allocate it, and you saw before, some of those ETFs, they have 600 holdings, some of them only 421 holdings, right? So quite a difference, yet the total performance over a 5-year period, well, very, very similar, even across smaller periods. I mean, that's quite surprising, I must say, that they're so closely aligned across the different periods. Right, so let's start off with the first index, which is the FTSE Developed Europe Index. And here we see the 2 ETFs that are tracking that particular index. So once again, index is like S&P 500, which you can't directly invest in, but you have an ETF provider such as Vanguard or iShares from BlackRock or others that we'll probably see later on. They are mimicking that particular index. So here we have only from Vanguard 2 options, either distributing or accumulating. I always talk about, right, it's your personal choice. Unless there's any tax difference to go with one or the other, it's really personal choice if you want to get paid your dividends or you want to automatically have to reinvest it. Most countries don't differentiate taxation-wise, so if there's no difference, it's personal choice. In my case, I usually like distributing, but now I also bought the NASDAQ 100 accumulating, so there's really no right or wrong. It has to work for you, and obviously that's why there is two choices. In this case, the distributing is actually the more popular one, it seems, because you can see the fund size is at 3 billion versus accumulating one less than 1 billion. So there is definitely a difference, even though the total expense ratio is the same. So let's focus always on the bigger ETF. In this case, the first one, distributing. Let's jump into this. And you can see here a quick overview of what it is. The expense ratio we have, once again, it's distributing. Full replication, for me, that's always important. Basically, they're actually buying those shares within the index. Fund size, 3 billion, we talked about it, and 536 holdings. Meaning, when we go into holdings, that's how many companies are actually part of the particular ETF or index, depending on how you look at it. And here you see the top 10, which have a weighting of 21%. So quite significant when you think about it. Again, similar to the S&P 500, it might be even more over there. But yeah, quite big, especially when you consider that you still have over 500 companies in total in there. So here we see the biggest one, of course, Novo Nordisk, which I believe is still the most valuable company in Europe even. Then we have ASML, that's the company I spoke about before, from the Netherlands. They produce basically all the equipment for companies like TSMC in Taiwan to build those super high-end chips. They need equipment to build those chips in the first place, right? And ASML is really #1 leader in that space to manufacture and sell to those chip manufacturers. So really impressive company. You see some other familiar names, Nestle, AstraZeneca, Novartis, SAP, Shell, LVMH, which really dropped. They used to be the most valuable company not so long ago. I remember I actually owned some of the shares, but well, we see globally what's going on with prices increasing, inflation happening. People are cutting back on their luxury spending. It definitely took a hit over there. And then HSBC holding here as well. So in terms of country diversification, really nice to see. It's really Europe. So it's not EU itself, but actually a European continent, because it still features United Kingdom. So with this index, you really get the whole European companies, which I think is a great thing. You really get a more diversification. You can see some more countries listed. Of course, Switzerland, I was surprised in terms of total contribution, 15%, then France, then Germany, and then some of the other countries we see in Europe. Sector diversification, also nicely balanced. Let's open up over here. You can see not one sector really outweighing things. For me, quite interesting, technology, right? I'm really a person who is tech savvy and believes in tech long term. That's why I also recently invested into the NASDAQ 100, because I believe the future is tech heavy and we're going to see more and more tech. So for me, seeing it that low is a little bit worrying, to be honest. But then at the same time, let's be honest, in Europe, we don't have so many, super successful tech companies, which is unfortunate. Financial companies, we do have some industrials, right? That's what Europe used to be known for. Heavy industry, car manufacturing, all these kind of things. Healthcare, that's good as well. Consumer discretionary, again, that's not really something I'm super excited about for long term. I think it's nice, it's a balance. But yeah, I wish it had more technology. But anyway, it is what it is. And overall, across the different sectors, I think it's a nice diversification. Let's have a look at the dividends. And honestly, if you like dividends, it's actually quite attractive for an ETF. Currently, you'll be getting 2.9%. And if we go down, last year was even 3.38%, 2.89%. So obviously it fluctuates. Some companies will increase their dividends, some will cut their dividends. But overall, if you like dividends, that's actually not too bad to get that from your ETF. Because in my S&P, I believe I get 1.3, 1.4% dividend right now. So that's more than twice. So quite attractive if you're into dividends. Right, we saw how it compared to the other European indices. So pretty much similar, but let's have a look how it compares to S&P 500. We take in this case, for example, Vanguard S&P 500 to compare Vanguard to Vanguard is also distributing. And on a year-to-date base, well, unfortunately, it's actually really underperforming. And that's what my feeling was. And again, that just confirms why I'm investing so much in the US, even though historic returns are not a guarantee for future returns. But yeah, year-to-date for 24 alone, it's less than half the returns. And that's quite staggering because, of course, we looked at technology being so strong in the S&P and NASDAQ 100 even more so. And while in Europe, it's sadly not so prevalent, at least not in this index. I'm sure there might be technology-focused ETFs out there. But here we want to buy the overall top-performing companies in Europe. And there's just a lack of tech there, unfortunately. If I zoom out even further to a longer period, well, the difference gets even bigger. We are now back to 2013, so around 11 years, and the difference is quite staggering. For European returns, in around 11 years, you would have returned only 131%, while with the S&P 500, pretty much 3 times the amount, which is absolutely staggering, almost 400%. So yeah, I mean, looking at that, unfortunately, I really wouldn't be sold on investing into European ETF. Now, again, there are some great companies that have outperformed the S&P 500, individual companies from Europe. But again, that's the question of finding the needle in the haystack, right? You have to really pick the winning company. And while, for example, ASML is doing very well, or Novo Nordisk, are they continuing to outperform the S&P 500 going forward? Who knows? So let's try another index, the STOXX Europe 600, with 600 of the biggest companies in Europe. I want to go with the biggest ETF provider, in this case, Amundi. I personally don't use this ETF provider, but they seem to be quite popular in Europe. So let's open it up over here. And interestingly enough, in this case, the biggest one is actually accumulating rather than distributing. The number 2 is distributing. So they're kind of closely matched over here. So the second one is from iShares, BlackRock once again. The expense ratio is quite a difference. iShares usually tends to be slightly more expensive because I guess you get the BlackRock name at 0.2% versus 0.07. So in this case, you might want to go ahead with the Amundi one. But ultimately, the overall performance is more or less the same. There might be slightly tiny deviations, but overall, they all track them fairly well. So I wouldn't really be too bothered with that. The overall total expense ratio, that's more important. That's quite a difference here between those two. So I understand why it is so popular, obviously. Now, when we go to holdings, it's pretty much the same. So I understand it's actually based on the market capitalization of the companies in Europe. In terms of country diversification, we see over here, France seems to be on the second spot over there, a bit more weighting than in the previous ETF we looked at, Switzerland on third spot, then Germany, and then some of the other countries. Let's see the sectors, how they're diversified. And once again, technology just isn't there. And that's just because we have a lack of strong technology companies in Europe. That's really a shame. Hopefully we'll see more of that in the future. But yeah, with all those, for example, AI regulation, right, coming out, Europe is very good in regulating, which I guess for us consumers and users, that can be sometimes good, valuing privacy and so forth. But I think it also hinders progress, right? For example, ChatGPT, the new voice feature, which you can use on the phone. I'm based in the UAE. I can use it. My friends and family members in Europe, unfortunately, I can't because it's blocked by EU regulation. So these things, of course, a little bit unfortunate. I think it just hinders the growth of those tech companies. And that's why we see in the performance, we're just lagging behind. Now, obviously, you won't see any dividends over here because they don't pay out, right? It's accumulating. So in this case, Amundi, whenever you would qualify for a dividend, they basically take the dividend and buy more shares in that ETF on your behalf. So you're just building a bigger position over time. If I go into the distributing one over here, and then you will see the dividend tab, I can just jump over here and you will see you will be getting the dividend. So here, instead of being paid out to you with Amundi or any accumulating ETF, they would just buy more shares in that ETF. So really, the total is no difference unless you don't reinvest the dividend you get right away. Then in the long term, you will actually underperforming the accumulating one because there, as soon as you get it, you reinvest it, right? So that growth and compounds in your favor, while here you have to manually reinvest it and do it right away because every day that you miss over a longer period, that actually goes out of your total returns. So let's compare it to the S&P 500 accumulating one. And once again, if I go to year to date, you'll see basically similar story as it returned more or less than the other ETF, half of what the S&P did. And if I go to the longest period, which only here in this case goes back to 2019, so around 5 years, once again, it's less than half the performance, 60% for that particular one versus 128 for the S&P. So yeah, however you look at it, is unfortunately underperforming. So I could go through the remaining 2 ETFs, but as you saw before, the performance is virtually the same. More or less, it tracks similar things. And once again, it just shows you the lack of strong tech companies that we have in Europe. Now, talking about European tech, I actually had a quick Google and found actually one ETF provider, iShares from BlackRock, the STOXX Europe 600 Technology Usage ETF. So that's the distributing one. So there is actually one that really focuses on tech. So let's see how that actually performs. Now the expense ratio is rather on the high side, 0.46%. On my NASDAQ 100 ETF, which is also iShares from BlackRock, usually more expensive, I pay 0.3, which for me is already quite expensive, but all right, be it as it may. It's distributing, so they pay out the dividend, even though usually for tech ETFs, I don't expect a high dividend because usually I want those companies to reinvest their dividends into growing their revenues and business going forward. So I'm not too bothered about dividends from pure tech ETFs. And then, of course, full replication, which is nice. The fund size is rather small. For me, actually too small, 189 million. Sounds like a lot of money. But when you really think about it, it really isn't. And that also impacts the spread that you get, the difference between the bid and ask price. So yeah, not too keen on that. And it only has 32 companies, which for me also, for such a small holding, they charge that much. I find it quite outrageous. Now, obviously, they have to charge more because the fund size is small. So it's often a double-edged sword, right? If you have a huge fund size, like S&P 500, for example, you can afford to have a lower cost because it's a smaller percentage out of a huge trading volume. In this case, the fund size is very small. If they were to charge only 0.1%, for them, it wouldn't be lucrative. So actually, when you run the numbers, this particular ETF returns BlackRock less than 900,000 euros per year, which is still a huge number, right? Just for kind of passively managing that fund. But yeah, for them, obviously, it's not that hugely attractive. So if they were to further lower the expense ratio, it just wouldn't get more attractive. So in this case, yeah, they keep it as it is. In terms of dividends, as I expected, honestly, I don't think it's even worth to get that money paid out. 0.46 is just not attractive, right? You have to have a huge portfolio to really have a noticeable impact on your dividend income. So for me, I wouldn't invest that for dividends, but for the performance. But first, let's have a look in the top 10 holdings over here. And you can see here, the top 10 makes up 84%. Of course, it's only 32 companies, but that's huge, right? ASML alone makes up 27%. So that's a massive holding. More than 1/4 of the entire ETF is from ASML alone. Then SAP, Prosus, not too familiar with that. Infineon, a couple of other ones over here. But yeah, that's really a huge weighting. And the 10th biggest one, less than 3%. So a massive difference between those. You see here the weighting of the countries. Of course, ASML from the Netherlands, that's why they have by far the biggest allocation inside the different countries. And if we look at the different sectors, well, it's a technological ETF, right? That's why it's 89% technology. So I'm sure with so much technology in there, well, I'm sure they will easily outperforming the S&P 500, which is more diversified. Well, friends, unfortunately, that's still not the case. As you can see, year to date, that particular ETF only returned 4.5%, even worse than the previous ones, which was much more diversified. And obviously, the S&P continued to return 26%. So it's just mind-boggling to see why it did so poorly with such strong companies. Well, at least ASML in there. The other ones, not all of them I'm familiar with, but they seem to have underperformed significantly. If I zoom out even further, well, it has been operating since 2012. Let's say we go back 12 years. So here it returned 367% versus the S&P 534. So here it's actually better, to be honest. It's still underperforming the S&P by far. But yeah, overall, in the past few years, they have been very closely aligned. But then they really fell off the cliff. From 2022, 23, they really dropped down significantly more than the S&P did and really lost the track and the ball over there. But yeah, overall, I mean, really interesting ETF. I would personally not be investing in that. And it's such a shame to see because, for example, if you would have invested only into ASML over here, the company that has the highest weighting in that particular ETF, when you look at the total returns, including dividends, they do pay a small dividend over a 10-year period. The S&P would have returned you 257%, while ASML would have returned you almost 3 times that, 707%. So a massive difference, given that they had such a strong weighting inside that ETF over here, as we see with 27%, and still the overall performance is so little, means that all the other companies, tech companies in Europe, really underperformed. And that's just really frustrating to see. And once again, does not get me excited to invest into a European ETF for sure. Now, what I can suggest though, anyone who does want to still support European companies, which is a great thing to do, right? And you want to have maybe, global exposure. So you want to have some European companies in there. I'm not saying Europe is ending and we're never going to have successful companies. Quite the contrary. I think we're going to have some great companies in the future, potentially coming up. But if you were to invest in Europe, I think you might be better off really investing into individual companies where you see a stronger future, because collectively we see them really underperforming. In this case, you might better be off with a global ETF or focusing a bit more on the US, which has historically done well, which is what I'm doing. And in this case, just double down with a smaller position into companies like ASML if you wanted to, or maybe LVMH if you think they'll make a comeback, or Novo Nordisk, or any of the other great companies that we do have in Europe, right? But as an index and ETF, honestly, I've been really unimpressed by any of those numbers. And personally, I will not invest into any of those ETFs. But let me know what you think. Maybe you're investing into any of those, or you have any great European ETF that I should be checking out. Let me know down in the comments below. Happy to hear from you. Hope you enjoyed the video. If you did, give it a like. It helps it to be seen by more people. Next up, check out this video over here. As always, thanks a lot for watching. Stay healthy, get wealthy, and I'll see you in the next one. Ciao.